So good morning, everyone. I'm Bethany McLean. I'm thrilled to be here this morning with Jim Chanos, who is one of Wall Street's best-known skeptics, probably most famous for his early call on Enron. In early 2014, Jim began expressing serious doubts about drug company Valiant, and I think he has views on other topics that are of great interest to our audience. I'm also thrilled to welcome Kyle Bass, who is best known for his contrarian bet on subprime mortgage assets heading into the financial crisis of 2008, a bet that netted your firm multiple-digit returns, and more recently, United Development Corporation, another target. If you want to Google it, that one just hit the news. Jim and Kyle are always provocative, and I want to try to learn from how they think as well as what they think. And even if what they provoke in you is violent disagreement, I hope that helps you sharpen your own convictions. I want to start with a topic that's of major importance for the global economy, and that's China. Let's begin with a question for the audience. How many of you are optimistic about China's economy? Can we see a show of hands? Interesting. So surprise, our two guests are not optimistic about China and haven't been for quite some time. Jim, you've got a great story about what piqued your interest in China. Will you share it?
Well, I mean, we got interested in China. We're stock pickers, and we're not so-called macro investors. Our interest in China came about in the fall of '09 when we were trying to figure out why it was that some of the commodity producers were reporting record profits into the teeth of the global financial crisis. And we knew inherently it was due to China. And we're talking about iron ore companies, steel companies, aluminum, cement, copper. And my real estate analyst was putting some figures on the board and said currently China has under development 5.6 billion square meters of high-rises, roughly half residential and half office and mixed use. And I said, he was a young man, I said, well, Alex, you're getting your nomenclature wrong because we think in square feet and they're square meters. It can't be 5.6 billion square meters, that's 60 billion square feet. And he looked at me as only sort of a terrified young analyst could. He said, I triple-checked it. It's 5.6 billion square meters. And it sort of hit me that if half of that was office space, roughly 30 billion square feet, that was a 5-foot by 5-foot office cubicle for every man, woman, and child in China. And that's been built over twice now since 2010. And it really rammed home to me the scope of the urban build-out that was occurring in a very short period of time in China and just how much debt was being taken on to do it and what a basically one-off for the world economy this is turning out to be. And we still believe that.
So back in 2011, another prominent Wall Streeter dismissed you by saying shorting China is basically shorting the march of history. And even today, people say that you're wrong because China's official growth figures have been strong and are projected to continue to be strong. What do you make of those arguments?
Well, I always point out first it's a communist totalitarian state, so the figures are going to be what they want you to believe. More importantly, though, even with that, when we started looking at China, China's nominal GDP rate was about 16, 17%. And that's the important one for paying off their internal debt. And it's now about 8%. It's actually ticked up from 6 because they've gone back to slightly inflation versus deflation. So their nominal growth rate's been cut in half in the last 5 years. Their markets have gone nowhere, albeit with a lot of volatility. But more interestingly, we've been involved in sort of the first derivatives of China, Macau, iron ore companies, cement companies, shipping companies. And they've been just absolutely terrific on the short side. So in a general global bull market, one of the few places you've been able to hide has been in the China play.
Kyle, you went public with your views on China a year ago. And for you, it's all about the banking system. You have a great chart. Can we show it? And can you help explain it?
Sure. This chart is a subset of what's most relevant in the banking system. To the crowd, what's important to understand, what Jim just said, is absolutely it's earth-shattering, right? Given the build-out of both commercial and resi space in China. But what fuels that's a banking system. So we studied the banking system in the U.S., in Europe, Japan, and China, and that's where I think our expertise is. But when you look at their banking system, they have an economy today of about $12 trillion in GDP. They have $37 trillion worth of banking assets. So they have 330% of their GDP in their banks. To put it into context, the U.S. going into the financial crisis was about 170% of GDP, including the non-banks, the Freddies, the Fannies, and all the non-bank non-depository institutions. This chart here is a subset of that banking system. And what's relevant here, if you remember the asset liability mismatches, those vehicles called structured investment vehicles or ABCP conduits or those kinds of things, where the liability side rolls very quickly, but the assets inside are like 7, 10, 30-year assets. So these are asset liability mismatched products in the banking system. At our worst, we were 2.5% of our system in asset liability mismatches, and things that really brought the acuity of the crisis to the banks right away. In China, there's $4.5 trillion worth of asset liability mismatches today, as per Chinese bank annual reports. And that is almost 4 times as bad as the US was. And so the point I'm trying to make is with this slide is, in kind of the worst possible kind of assets, it's 4 times worse than we were at our peak in 2006. So for those that believe somehow China, with a declining working age population in a banking system that's been recklessly built, if we think China is going to grow 6.5% from now on, or 8% nominally, I just think that they're wrong. And I think that if you follow what's happening right now, sometime in the next 18 months, you're going to see a real banking crisis in China. Even though they are a communist totalitarian government, economic gravity takes over.
Well, to amplify on Kyle's point, what you have now is you still have a banking system that is growing assets at 2 to 3 times, depending on how big the shadow bank system is, of nominal GDP. So we think banking and shadow banking assets will grow somewhere around 20% this year. Put that in perspective. That, as he points out, that will be new debt to the tune of 6-7 trillion US dollars in a 10-11 trillion dollar, 12 trillion dollar economy. And I would dare say that if the U.S. did a similar type stimulus, say 10 trillion in new debt on a 17 trillion dollar economy, we'd be growing at 6% too. There's no magic to this. I mean, they're literally almost half of the economy is construction still. After all these years, it's still investment. And so, of course, the problem becomes every time you finish a building, you reset to zero. You've got to start to build a new building. And this is the inherent problem. And it's, by the way, very similar to something Kyle knows better than I do. It's very similar to the Japanese model in the late 80s, except this one's on steroids.
There's a big difference, and we'll let you start. The big difference between China and Japan is China doesn't have any international assets, right? The Chinese people, in general, only have about 20% of their GDP invested externally. So China has this impossible trilemma. They want to try to hold their exchange rate constant. They want to liberalize their capital account, open their economy, and yet they can't do those things all at the same time because it will decimate their currency. So they made a lot of money by basically exporting cheap labor or cheap labor's benefits to the rest of the world. But if the Chinese are allowed to travel some more and buy some foreign assets, it basically means it's just China's going to need to readjust. It's not the end of the world. This isn't a Lehman moment. It's a moment that those that are allocating money to Southeast Asia need to be really wary of in the next 2 years.
So just as with Jim, a lot of people think that you are dead wrong. You noted earlier this year that you've had numerous discussions with various Wall Street firms, consultants, other respected China experts, and they almost all think you're wrong. Does this bother you when most people think that you're wrong?
Well, I know, Jim, yes, it bothers me. But
it does?
I'd love to tell an anecdote, so I'll leave the person's name out of the conversation. But last week, the chief economist of one of the biggest investment banks in China came to see me. And she had written a rebuttal to something that I wrote in February, basically saying that the Chinese foreign exchange reserves aren't exactly what they're reporting. And I went through a very detailed analysis using all the facts provided by China's statistical services showing how the number didn't reconcile. And she said, well, Heyman doesn't know what they're talking about. Kyle doesn't know what he's talking about. That the sovereign wealth assets for the sovereign wealth fund are not included in the FX reserves. And so I put the sheet of paper in front of her that showed 10 years, actually 20 years of this data series. And I said, well, if it had been subtracted, you'd see a step function change in the PBOC's data series. And she said, well, reporting out better in 2010. You just have to believe me. And that's, I think this belief, and I call it this apostolic belief in Chinese government's omnipotence, is what everybody tends to believe in,
Yep.
right? And if you just look at the facts, right, you wouldn't invest in China today. And that's the point that I make. So all the arguments that I try to make are fact-based and not, just believe in the government. And I think that's a lot of what Jim does and what I do. And unfortunately, it's a lonely place, right?
Yeah.
Jim, what's wrong with trust me? What's wrong with apostolic belief in omnipotence? It sounds very reassuring to me.
It does.
It can be more profitable for a while, but ultimately reality does tend to hold. And look, I'm being used to be called wrong. I was married for 20 years, so that's something that you get used to pretty easily. But again, the data is telling us that something is unprecedented is happening in this country, and I think that for those that believe in the omnipotence of the Chinese Communist Party, I would just simply point to 2015 as the summer of 2015, when the government, which had promoted the stock market and told people to go buy stocks on leverage in late 14, early 15, suddenly realized they had a problem on their hands and tried to put it in reverse and caused a crash. And then just put out a series of just mind-numbing, conflicting directives and orders to the financial markets. And if anyone really thinks that this group of 7 guys in a room has the markets figured out and has financial plumbing figured out, they didn't. It was very clear. And so I think that you only need point to a little over a year ago to see their response in what was basically a stock market crisis to have some concern.
Let's back up a little bit. You've said that validation by pundits is not what we seek. We are comfortable taking a controversial stance on events that others deem to be impossible. Were you born that way?
God, I mean, it's a blessing and a curse. I wasn't born that way. But I think through rigorous data analysis, you draw your own conclusions. And I think like you did with Enron, you caught a lot of flack on that early on, and you ended up being dead right. One other thing I've said that Dan Loeb quoted is no one's ever going to erect a monument to a short seller. So you're always going to be in the minority, and you're always going to be someone that's skeptical. I'm generally an optimistic person. I'm just skeptical of believing everything that everyone tells me, and it's a lonely place. But I don't know. I just think if you do all of the work, you have to draw your own conclusion. You also have to stick to your own conclusion.
Jim, you've been doing this for 30 years. Has experience made you more of a contrarian, or has it tempered you?
I think it's probably tempered me. I mean, we talk in our shop and about what it takes to do this, and I used to think that good short sellers were made. That is, you do the work and you get better and better at it. And over time, I've sort of scrapped that belief, and I actually think that to be on the short side, fundamental short side of the market, you sort of have to innately be born with that. And by that I mean, from a behavioral finance point of view, I mean, all the people in this audience, and certainly my companions up here, are the results generally of societal positive reinforcement cycle. Go on to school, get good grades, get a good job, do well, get promoted. Wall Street is a giant positive reinforcement machine. You come in every single day, and of all the stocks, I'm short a good 10 to 20% every morning. Earnings estimates are raised, takeover rumors, CEO is on TV, whatever it might be. And I call that sort of the Muzak of the investment business. It's just always there. And if you're a professional skeptic, you're coming in consistently and you're being told you're wrong. And that studies after studies have shown that most rational people's ability to keep making good decisions breaks down in an environment of negative reinforcement. Interrogation is the ultimate example of that, for example. And if you're coming in constantly being told you're wrong, you're wrong, you're wrong, you begin to go with the life is too short. And yet, good short sellers have had positive returns in intergalactic bull market, and I've always said that a good short portfolio allows you to be more long. And that's the crux of what we do. It enables our investors or ourselves in our own funds to be more long, whether it's passive or stocks we select, because in effect we're financing it with our shorts. And at the end of the day, that's a pretty good deal. It's Kyle Bass and Jim Chanos are in the insurance business, and except that generally the insurance pays premiums. And in finance, that's a pretty good deal.
So many years ago, you said to me that you had no shortage of finding talented young analysts to work for you, but you did have a challenge finding people who actually could maintain their conviction in the face of that. Do you think more people think they are contrarian that actually are so when push comes to shove?
Yeah, I mean, I think, I don't want to answer for Kyle, but I'd say, yeah, come in and be short a diversified portfolio of crummy companies in a bull market, and then I'll let you know whether you're a contrarian or not. Because until you get paid, it can drive you crazy. So you have to have the courage of your convictions. You have to do the work. But you need to stay with it if you know, within risk parameters. And that's really, really hard to do on Wall Street.
Kyle, speaking of the courage of your convictions, you told your investors that once you came to your conclusions about China, you decided to liquidate the majority of your risk assets. Go big or go home? What about just dipping a little toe in the water?
You know, it's not really go big or go home. When you come to the conclusion and you think about the concentric circles that surround the conclusion that China is going to have a banking crisis, that just is not very positive for China, clearly. It's not positive for anyone with their currencies pegged to the dollar as China falls apart. It's not good for anyone in Southeast Asia. It's not. They're the growth engine of the world. So if you're investing in things that rely on multiple expansion and profits growing, if I'm telling you that in the next 18 months profits are probably not likely to grow, or they're going to grow a lot less than are modeled today, then you know. And I say that in a blanket statement. We sold the majority of our risk assets. We have a couple of risk assets, but you know, when you think about big thematic macro views of banking systems over the last decade, you know, we haven't gotten any of those wrong. It takes a little while for things to happen. You know, you can't be arrogant enough to think that in a multi-decade super cycle that you can call call it timing with any precision. The difficulty is in today's kind of world of very small attention span of both investors and their ability to stay with you. That's the challenge that I think we have. You know, these are 2 and 3 year events, sometimes 4, and you know, everyone wants to know how you did last month or last quarter, and I think that's the kind of duration mismatch in expectations is the hardest thing to manage. And I'd ask Jim if he has the same issues, but I think that's really the key for us.
I think I heard you say once, it's easy to maintain conviction, it's harder to maintain investors.
That's right.
That's interesting. Jim, over your years in this business, you specialize in pattern recognition as well. Have you come up with certain patterns you see that make you say, there's a problem here? What are your top 3 red flags with a company?
Well, for the average investor or who's just trying to avoid torpedoes in their portfolio, again, I wouldn't advocate short selling for a variety of reasons for just the average investor. It doesn't make a lot of sense. But there are certain tools that we look at that can help you make you a better investor, if you will, to deselect these things from your portfolio. An obvious one, this one's really simple, but it's been highly predictive in our history, is when you see a controversial company where there is not only large number of executives selling large amounts of their stock holdings, but also departing. Real simple. It would have alerted you to Valiant Pharmaceuticals very early on and into the crisis of just the numbers of people. We actually had a spreadsheet we kept posting of all the departures. And it was senior people. They were leaving every few weeks. And that little crib sheet right there, along with their stocks, would tell you, you know, if they're getting out and more importantly leaving the company, maybe you should be too. And yet, you know, people defended it. So that's a simple one. When you see companies explain away accounting issues that you know are not right and just make no sense, but then hide behind, well, it's GAAP accounting or whatever it is, that's also a time to be maybe a little bit on guard as well.
So here we are, Jim, in the land of visionaries. From Jeff Skilling of Enron to Mike Pearson of Valiant to Elon Musk, I see you as a skeptic of visionaries. Is that right? And if so, can you explain your thought process? What do you see that others don't, or what do you see or what don't you see that others do?
At Tesla in Solar City?
Or in general, with visionary figures.
Visionaries? Okay.
You could go to Tesla.
Well, often these kinds of stocks, and I can think of one in China as well, where there's a fellow who sort of invents a new way of looking at things. I teach a course on the history of financial market fraud, and one of the models we look at is a wonderful checklist by a woman named Mary Ann Jennings, and it's from a book called The 7 Signs of Ethical Collapse, and I will tell you that both at Valiant and Enron, the CEOs and the situation fit about 6 or 7 of them. And one of them is innovation like no other. Another is larger than life CEO and a compliant board. Another one it was sort of fascinating, is good works in one area tries to atone for evil in another. And there's a number of companies that we're short now that fit that checklist almost perfectly. So we keep an eye on these kinds of things, because when you get bad governance, but with messianic leadership, and certainly one of the companies that we just referred to is, in my opinion, showing some of the worst corporate governance I've ever seen, you have trouble on your hands.
Do you think Elon Musk is a messianic leader?
I think there's no doubt that Elon Musk's shareholders think he's a messianic leader.
Kyle, you founded the Coalition for Affordable Drugs in order to challenge pharmaceutical patents. It's been really controversial. One expert even called you a patent troll. And this is an emotional topic out here, this idea of challenging patents. Another has said that your tactics may result in people not getting medicines they need. Does the controversy bother you?
Oh, I mean, cry me a river. You have drug companies that have margins greater than that of Google, that didn't invent the drug, that rent it, that can raise the price every year as much as they want to raise it, because Medicare and Medicaid can't negotiate drug prices. So you have companies like Valiant pop up. You have companies like Mylan with the EpiPen. A couple of years ago, a year and a half ago, I gave a speech about Mylan. The EpiPen, adrenaline or epinephrine, fell off patent back during Vietnam. The Vietnam War, and the only thing that protects Mylan's EpiPen is 4 patents surrounding the retractable needle. So the medicine itself is not patented, and yet 10 years ago an EpiPen cost $50, and today it costs $600. And why? Because the system is set up to protect the drug companies. And so challenging kind of what I deem to be dubious patents just sounded like fun to me. And I had enough capital and enough time at the time to kind of challenge some of the worst. I had the benefit of negative selection. I could look at all 11,000 patents and decide which ones were bad. And I'll make one example. We won one last week that actually didn't receive any fanfare, but we paid all of our lawyers, all of the lawyers we hired to file all of the challenges. I said, instead of public companies, let's just give me the worst patents you can possibly find, and I'll sue them personally. I'll go after them myself and my partner, Eric. So one of the ones, there was a tie for 2. We only wanted 1, but we had to do 2. One was, there was a pill called Suprenza. It's a diet pill. And the innovation, there was 1 patent that protected this drug and enabled them to charge Medicare whatever they wanted. The innovation was the speckled appearance of the pill. It's a white pill with blue specked dots on it. The irony is it's a diet pill and the specks were sugar granules. And so in our patent challenge, we wrote, obviously no one at the US Patent Office has ever chewed Tutti Frutti gum. because this was innovated long ago and doesn't deserve a patent. So the interesting thing was the owner of the patent didn't even respond to my challenge, and we won right away, which I don't know if that's ever happened before. The other one is, like, I'm just pointing out how stupid some of these things are.
Yep.
One is, if anyone's had surgery, you've probably had 9 times out of 10 you get propofol, which is called Diprivan, and it's your general anesthetic that literally everybody gets. It's a World Health Organization essential medicine. It is on the list of essential medicines globally because of its relative importance in surgeries. And get this, so the medicine inside lost its patent long ago. However, there's one patent that protects propofol. It's, in an injectable, you realize there's a glass vial with a rubber stopper that you have to stick a syringe through to extract the medicine. The patent that protects propofol is the siliconized rubber stopper. It is un-effing believable that these things exist. And so from my perspective, it was kind of a David and Goliath fight, but it was one that was kind of fun. The interesting thing was, right away, the pharma lobby hired 100 lobbying firms to fight me.
Wow.
So, and I know this because they tried to hire a couple of my friends. They're vicious. And I know a lot of people have gone after you for being skeptical. But
yep.
the drug thing's been fun, but it's been a battle that I actually underestimated how much the other side would come after me.
Jim, I want to go back to Elon Musk for a second. Can't leave this one alone.
Who?
Not here. So one commentator wrote in response to one of your salvos against Musk, here's the harsh reality for investors and analysts. Elon Musk is smarter than all of us. What do you think whenever you hear that such and such CEO figure is smarter than all of us?
Yeah, I remember a company that you and I had something to do with. Jeff Skilling was considered, they were called actually the smartest guys in the room, as I recall. And there's a difference sometimes between being smart and being clever. Look, I have no doubt on Mr. Musk's intelligence. On the other hand, I'm analyzing the company and two of his companies, SolarCity and Tesla. And the fact of the matter is that this is a company, Tesla's case, that is now really going to need to step up the production, is going to be competing against Mercedes, Audi, VW finally, who are bringing product lines as an OEM. And this is a car company. This is not a high technology company in that people forget that battery technology has been around for a long time. It's not subject to Moore's law. It's a basic chemical reactions. The battery technology is Panasonic's, not Tesla's. A lot of people are continually stunned to find that out. And has been leapfrogged already by most of the other OEMs, making the Gigafactory, somewhat of a giant white elephant out there in the Nevada desert. And then on top of that, he tries to buy SolarCity, which is basically a roofing company with a consumer finance arm attached to it. It's not a high-tech company. And it's not a very economic business in and of itself, selling you power at 17 cents a kilowatt hour. So the whole thing is just sort of this melange of publicly traded and privately traded science projects sort of gone awry. And so we'll see how it all works out.
Publicly traded science projects gone awry. So I want to open it up to Q&A, but I hope that everyone has indeed found this thought-provoking. I've always believed that you agree or disagree, you dismiss skeptics at your peril, because when they're right, they are right in a major way. So please go ahead with your questions.
Jim, is Valiant fixable?
It's a really good question. So the Valiant model that Kyle and Bethany alluded to was an interesting model. It was to buy drugs, not develop them, and buy drugs that the seller, for whatever reason, and I kept asking this question as the roll-up, which is what it's called, when you buy businesses as opposed to develop them. What did the sellers see here? Why were the sellers so willing to get rid of a toe fungus drug, Jublia, that was selling for treatments for hundreds of dollars, where Valiant could hike prices to $8,000 a treatment? And it was no more efficacious than Vicks VapoRub. What did the sellers see here? And of course, what the sellers saw was that for most of these drugs, which were dermatological and ophthalmological, they were not Medicare and Medicaid drugs. They were subject to private pay, and that many of them did have an economic life. Right now, we believe Valiant's portfolio of drugs has an economic life of about 8 years before it's subject to real patent and competitive pressures. And so what was crazy for us was that investors, Mike Pearson, sold people the idea that the amortization of those purchased drugs, remember, you're going to have to replace them, was an expense, should be added back to earnings. So that a company that was losing money on not only a GAAP basis, but on an economic basis, if you amortize the drugs, and the SEC makes you amortize purchased R&D over 10 to 11 years, so even then it was being liberal to them, was actually earning, $8, $10, $12 a share. That's how the stock got to $260. And the problem is that everybody woke up in the fall of 2015, and the private payers woke up. And they said, we're paying what for Jublia? Are you kidding me? No. And this movie has to play in reverse. And I think it's going to be very, very difficult. Keep in mind there's $37 billion of net debt and long-term liabilities at Valiant ahead of the common. So the whole company has a market cap still well above $40 billion, which is what they purchased all the drugs for. They basically bought $40 billion worth of drugs. I don't think he could get $40 billion today for what they put together over the previous 5 years using this business model. So I think it's tough for the equity to have a lot of value. There might be value in the debt.
If you can't trust the official numbers coming out of China, how do you go about finding information you can trust?
There are a few databases that come out of China, and they're trying to improve their reporting as a government. And there's the CEIC database, which is in English. There's the WIN database, which is in Mandarin, and there's China Bond, which is also in Mandarin. There are some decent levels of data that come out of there, but in the end, when you see an FX reserve number cross the screen, it's whatever number they want it to be, and so. I think that you have to be real careful in believing what you see in China. You just have to try to triangulate it in many different ways. One of the best. I'll give you a really interesting binary example. They report their dollar FX reserve number once a month, and all that is the PBOCs, their central banks' reserves or foreign assets. So they report the reserve number, but they also report in the CIC database all assets and all dollar assets in the PBOC. And while one line's been flat for 6 months, the other one continues to fall with a slope of -1. And yet they're basically admitting that they're lying by putting forth these two data sets. And if they also put forth a data set that you quote in a letter, like I did in February, that they didn't like, the very next day they'll just take the data set down. It'll no longer be available.
We've seen that.
And so, I hate to be too skeptical, but that's the way it works over there.
And if you think it's bad on a macro basis, when you analyze the companies, oh my God, they are a nightmare in terms of trying to figure out where the cash flows are going because of the variable interest entity structures offshore. My good friend Jim Grant said it best. It's the People's Republic of Madoff. And I think that sort of says it a little.
On that note.
One other thing, like we're here in Silicon Valley, right? The Uber Didi scenario, right? Uber was never going to win in China. There's also this level of, call it quiet protectionism, where they'll take the innovative side of the U.S. companies or the Western companies, and they'll let you spend a lot of money trying to win in China, and you'll never win in China. And the Chinese company will always win. And I think Uber's deal with Didi was just basically, this is the best deal Uber could have done, right? Or else I think it would have really gone poorly if they'd have kept pushing.
Well, the People's Republic of Madoff is definitely going to stick in my brain. Thank you all so much.
Yeah.